Welcome to the Barometer Readings Monthly Conference Call. My name is John, and I'll be your operator for today's call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session. Please note that this conference is being recorded. I will now turn the call over to Mr. Nick Hamilton. Mr. Hamilton, you may begin.
Thanks very much, operator. Hi, everybody. It's Nick Hamilton here, Vice President, National Sales. Welcome to the Barometer Readings Monthly Conference Call featuring David Burrows, our President and Chief Investment Strategist. So since our last call, it clearly continues to be a market which favors tactical and targeted managers, which of course is what we're all about. Rising bond yields continue to punish interest rate sensitive areas of the market, such as REITs, utilities, and telcos, not to mention fixed income. Markets also continue to process what a future tapering of monetary policy could mean to global markets. And also, in these summer doldrums, there's even seasonal weakness to account for. In this backdrop, at Barometer, we've been quite proactive throughout the year within our portfolios, making appropriate tactical moves for our investors. And so to provide a refreshed view on our current observations and some of the progressive changes we've made throughout the year, I'll now turn the call over to David.
Hey, folks. Dave here. Thanks very much for taking the time today. What I thought I'd do is start off the hop just with a quick overview as to what we're seeing from a top-down perspective across asset classes, how that's had influence on the progression of the holdings in the portfolios across both the income and the equity mandates, and kind of how that's working out. As we've said over the last few calls, since really November of last year, we have been in a market that is, quite favorable to the strategy that we use, which is really to try and target, core leadership groups, and be prepared to be out of certain groups. We're in a market where geographically and from a sector perspective, there are have and have-nots. And I think for a lot of investors, they're finding out some of the downside to very specific mandates, and with respect to bonds certainly, and Canadian in particular product. But just to start from a high level, certainly through the course of this year, we've had a much more significant weight in equities as a whole, as an asset class, a much reduced bond exposure. And from a geographic perspective, we've been pretty targeted in the U.S. Just to start out, when we take our breadth-based models, which measure the percentage of securities within various groups that are performing well from a price perspective, the clear and continual leader globally through the course of this year has been the U.S. market. Over 70% of stocks in the U.S. market have long-term positive price trends. Volatility has been relatively low. We hear the discussion of all of the choppiness in the U.S. equity market over the last 2 weeks, and it's a couple of percent move. It's been a year where there's been remarkable resiliency, and very, very good flows into equities in general. If we look at it, U.S. market probably has the most persistent demand, and we see very strong flows there. If you break it out another way, developed markets in general, significantly stronger than emerging markets, which arguably are higher beta, more at risk in the event that risk appetite backs up, which can happen when interest rates go a little higher. And when we look across a number of different markets, many of the emerging markets have had some deterioration in their breadth models, and certainly from a relative strength standpoint have been weak relative to the U.S. When we look at countries that aren't emerging markets but have exposure to emerging markets, like Canada, for instance, Canada has been an underperformer year to date. Countries like Australia and Russia have been underperformers year to date. So this has been a year where geographically you wanted to be quite targeted. When we go sort of from the equity asset class to the fixed income asset class, clearly through the course of the last few months, you've had a really significant backup in long-term interest rates, really equivalent to what would be a typical cyclical backup in rates. We've had about a 70% move higher in the yield on a 10-year bond. If you look at year-to-date returns, 30-year bond is down about 20%, which I'm not sure all of the investors that own those were counting on. Backup in a 10-year is about 12% so far year-to-date. And just to hit on a high note off the bat, in the income mandate, which is, clearly a total return mandate aimed at generating cash flow for the investors, it turns out this has been the 9th period of 9 since 2000 where, in a rising rate environment, we've captured some positive returns. Income Advantage Fund, I think, is up a little over 3% year-to-date against a pretty tough interest rate backdrop, and that's really had to do with the positioning that we've had in the portfolios. And let's talk about interest rates for a moment. We did this on the last call. There are things that are going to move interest rates, long-term interest rates, higher. You've got inflation, and if inflation were a concern, then that's going to hit asset prices across the board. At this point, really, there's no sign that inflation is a problem. Certainly, in fact, most countries, inflation is running below target and not moving higher. The second would be increased credit risk. And when we look at credit default swaps in all the developed countries, credit default swaps are, showing a very benign credit risk environment. So there doesn't seem to be a lot of concern there. The last one would be a stronger economy, a rising consumer confidence. And arguably, we are seeing that. And that's probably why there is widespread discussion about potential and some tapering starting in September. And we know that if you go back over time, you tend to see corrections when you start to price in some change in the interest rate environment. But when you get rising consumer confidence along with rising interest rates, it tends to actually be a pretty good time for equity markets. And in our strategy, we always look for potential catalysts. And then we look for price characteristics that would support the view. And while our short-term indicators for many of the markets around the world, equity markets around the world, have been showing some consolidation, the long-term bullish percent models have remained, in general, in a positive territory. So, there's two ways markets correct. One is through time and one is through price. We've had a little bit of price correction in equity markets. Specifically, and they range from market to market, but U.S. market very small. We are seeing some choppiness, sideways choppiness from a time perspective. When we go through the range of global markets, certainly emerging markets have had a tougher time. And when we look at the credit markets in those emerging markets, I think the culprit can be found in, there's been some rising funding costs for commercial paper in countries like India. Credit default swaps in countries like Brazil and Indonesia and many of the Latin American countries have widened out a little bit. And, these are canaries that we watch for. So how this all plays through is from the top down, bullish percent models generally positive. We are equity focused. Our bond models in general have been weakening, very low bond weights. Strongest readings are in developed countries and specifically U.S. Our equity weights are specifically focused in the U.S. And from a sector standpoint, many of the sectors that you would expect to do well in a stronger domestic economy in the U.S. are the sectors that are performing well and where we are focused. So we always have to watch as things change. A year ago, we were in a world of extremely low interest rates, hitting basically 30-year lows. We were in a market where having pure interest rate exposure was a positive. Our portfolios were largely, in the income side, largely focused in utilities, real estate investment trusts, and pipelines, and corporate bonds, things that are very specifically interest rate focused. If you look at the progression through the course of the year, if I go back to November of last year, our biggest weights REITs were 22% of our portfolio, utilities and pipes 21%, corporate bonds 20%. Our concern was that you could see rising rates in the short run, you could see a little bit wider spreads, and so by April, sort of down to 14% corporate bonds, and REITs were taken down to 13%. At the same time, things that benefit from a rising rate, some of the financials, in particular insurance and some of the U.S. money center banks, had been coming up in the portfolio. So to fast forward to today, if I take the income portfolio to start with, first of all, geographically, across our income mandates, about 40% of the portfolio is U.S., about 60% would be Canada. If I look at from a sector standpoint, the income advantage today is about 36% financials, by far the biggest weight, largely U.S. focused, where we see some multiple expansion and likelihood for dividend growth. Energy would be the second biggest weight at 15%. They're specifically yield-generating energy companies. These are companies that are benefiting from growing production and growing reserves. Specifically, when we look at the commodity space, the one commodity that really has been decoupled from the rest has been oil price year to date. And certainly certain geographies within North America are seeing really strong production growth, and we've been focused there. As far as utilities and pipes, really pipe is the only place we have exposure, midstream energy assets, and while we have a very strong and positive fundamental view on this group, clearly from a relative strength standpoint, there has been some correction in the group, and so that's down to about 7.5% of the portfolio, REITs about 7%. But, much greater exposure to industrials and consumer-related securities, again, focused on things that benefit from a little bit better domestic economy. So, look, this is a total return portfolio. It's an income mandate. There's a very broad range of securities we can focus in this mandate to let us generate returns in different markets. We're very pleased not to be handcuffed to have significant pure interest rate exposure in there, as perhaps a bond fund might be. But there's only so much you can do within that mandate. There's only so far out the risk curve we're prepared to go. And so while we're really proud as to how well that thing's doing against a tough interest rate environment, and while we think if we wind up in a more normalized environment, once the dust settles, people come back and start to say, well, where can I get cash flow without taking pure interest rate exposure? As we saw in the month of July, when interest rates normalized a little bit, the financials and the pipes and the consumer discretionary stocks really rallied nicely, and we think that that's likely later in the year. So we think that we're on very stable ground. These things are holding in really, really well against what has been a tough interest rate market. But we also, recognize there are people who might believe that back half of the year could be stronger as far as the economy goes. Consumer gets a little bit stronger. Economic activity picks up a little bit. And we are seeing, some rotation slowly further out the risk curve to things that are a little bit more economically sensitive. And certainly that's something that we're focusing on in the equity portfolios that we run. So equity portfolios also have a very significant financials weight, but consumer discretionary is a much bigger weight in the portfolio. Media and healthcare and industrials, more straight equity exposure is helping us on that front. So in the equity portfolios, things are going well so far year to date. We have a very significant U.S. weight, about 60% of the majority of the portfolio is up to about 70% in the long short would be U.S. focused. Financials, consumer discretionary, energy, as I mentioned, media, technology, industrials, all companies that are a little bit more economically sensitive are the targets. We have not gone that extra step out the curve into the pure deep cyclicals, like the metals, for instance. We think that it's too early to make that call when we look at earnings revisions for the fourth quarter. Actually, there's been 3-to-1 downward revisions versus upward revisions. For the market to make consensus estimate of $110 for the S&P 500, you're going to need to see double-digit earnings growth. We don't think that that's likely. When we look at the earnings coming through the most recent quarter, revenue growth was hard to come by. So we're not making a big bet on big acceleration, but we are invested in things that are benefiting from certain areas of pent-up demand, like some of the sectors supplying into household, auto, for instance, and technology spending. So as it stands, I think across the mandates, long shorts plus about 11. As of today, ETF is up about 10, equity up about 9. We're pleased. We've had very low volatility in the portfolios. They're particularly focused right now, and I think that we're in the right themes. Now, seasonally, we're in a period, August, September, where we tend to have some sloppiness and low volumes. There are lots of strategists trying to make a call to make that big leap out to the deep cyclicals. Our breadth models at this point don't support it. We don't think the economic data supports it. Don't think that at this point in a bull market it makes sense to make that big rotation. And historically, when we look at the data, what goes into the summer doldrums with the strongest relative strength tends to come out. You had a little bit better day today in the market. What did well? Healthcare, consumer discretionary, media, technology. These are the groups that have led coming in. So we're pleased with the way our positions are holding in. Lots of stocks were extended a little bit from a price perspective. They've pulled back in. When we look at the way that we've constructed, our client portfolios, high income continues to be a core. Last spring, we had a little backup in interest rates. The spring before, a little backup in interest rates. Both times provided a really good entry point because we think there's lots of folks out there who need cash flow, and they're going to continue to look for positions that can deliver a rising stream of cash flow, whether or not we're getting a backup in interest rates. We think that it is not a bad time to have some straight equity exposure, and all of the strategies, I think, are working pretty well. So overall, we're going through a consolidation in the market. I think that as long as we see consumer confidence the way that it is, as long as we see the breadth models hold in the way they are, some consolidation is not probably a bad thing in this market. Just trying to think what else I might want to touch on. Maybe what I'll do is I'll pass it back to Nick to wrap a little bit, and then we can take some questions.
Sure thing. Yeah. So just two ideas I'd probably want to just touch upon. One would be kind of some of the key attributes that make our strategy and what we do suitable for the time we're in, just to reiterate some points and some points of observation. Secondly, just some things on communication and marketing that we have that could be helpful. So, we're having a lot of conversations lately. We hear there's a lot of rejigging within portfolios going on at the moment, and that certainly is supported by the outflow that we're seeing from fixed income, from bonds, from interest rate sensitive names as well. So it's quite an interesting juncture for investors who obviously continue to need income, but there's this fear of rising rates and the effect that would have on their income portfolio. So in this backdrop, we'd really continue to highlight Barometer as a small, nimble, tactical manager, and more importantly, the flexibility that our income mandate has. If you look at the fixed income arena, you're looking at losses accelerating in Dex Universe bond funds, so off anywhere from 3 to 9%, depending on what you look at, and that's depending on duration, obviously. But half of those price declines have come in the last 30 days. So it is something that's accelerating, and that those are losses in a very, very low or higher sensitivity rate for volatility, obviously. So it's also worth revisiting, and David mentioned it quickly, but we've crunched the numbers of 8 previous periods since 2000 where the 10-year bond yield increases for 2 months or more at a time. We've successfully been able to skew the portfolio to things with pricing power and to produce positive rate of return. And that's by skewing, portfolio away from interest rate sensitive, away from fixed income, as is the scenario now. So we can own little to no fixed income and really skew it away from those areas. So that's kind of, the case for the suitability of what we do today. The second point I wanted to mention, which should be of interest, is for those partners that we've had good success with marketing our message with in past, we've developed an online tool featuring David that would very much be worth reviewing. It's called Barometer Insights, and it offers short clips of David discussing our core beliefs around, market return fundamentals, our disciplined leadership approach, as well as our very disciplined selling strategy. So we'll make a point of including that link in with the replay info when we have it, later this week, or just make a point of asking Sarah or I about that. So at this point, operator, will open it up to the Q&A, please.
Thank you.